As long as the gentleman gives me the leisure of time, I would suggest higher. I've had hours of discussions with you, Dunnigan, about the reason why I think the gold price inevitably goes higher. And my experience has been that when gold establishes the momentum in precious metals, and then the generalist investor comes in, that the generalist investor is encouraged by the momentum in gold and buys the asset with lower unit costs and more volatility, which is to say silver. This usually occurs about midway through a bull market. No reason why history has to repeat itself there. But when silver assumes leadership from gold, it moves further and it moves faster. I know that the gentleman would like me to give him a date. I'm too old and smart for that. I would just suggest to him that we're in the early innings of a precious metals bull market, and he needs to be patient for gold to establish a dominant trend before silver really gives fireworks to the upside. It's worth waiting for, by the way, Dunnigan. Your younger audience won't be familiar with the dynamics of a silver bull market. The first one, of course, that I lived through was the 1970s, where silver went from about $1 to $50. That's not representative, I think. A better market to pay attention to was the early 2000s market, from about $5 to about $50, a tenfold move in silver. Too many silver bugs these days have low expectations. High expectations in terms of time, but low expectation in terms of dimension. I read all kinds of stuff on the internet about the fact that silver might go to $35. I could care less about a $5 move in silver.
Rick Rule stated that he had experienced a couple of tenfold moves and even one 50-fold move, so a $5 move was of no particular interest to him. He pointed out that nationalization was almost always a sign of a market top, citing Zambia nationalizing the copper mines as an example, and remarked, "Boy, did they top-tick the copper price." Rule explained that in bull markets, prices move so fast that they outpace even the greed and incompetence of elected politicians and bureaucrats. From the time politicians decide that stealing private wealth is a good idea until they accomplish it, typically 3 to 5 years pass. He noted that while having a good asset stolen is bad, having it stolen at or near the top of the market is not as bad as it might sound. He addressed a question about the gold price moving from its current $2,300 to something like $10,000, which he didn't think was outlandish. Rule believed that if that happened, the probability of the African National Congress in South Africa stealing the gold mines and plundering them, as they did with the coal mines Eskom, was 100%. He also said that the probability of a gold-backed currency was nil because a gold-backed currency imposes discipline on politicians regarding their fiscal measures, and politicians live for power, not constraints. He believed the likelihood of seeing a gold-backed currency anywhere in the world, with the possible exception of Lenin, was nil. He mentioned that if you look at the amount of gold in Fort Knox and the amount of money in circulation in the United States,
you would need a gold price that was almost unfathomable to current holders to back the currency. But as I say, this is a fantasy. People who subject themselves to the indignity of being politicians are people with an unquenchable thirst for power. And a gold-backed currency would impose a discipline on them, which is unthinkable to them. Silver is always a byproduct of copper production. And so the amount of revenue available from a silver stream relative to copper production means that it's not in the company's interest to do that. In fact, what tends to happen is sort of the other way around, albeit not involving governments. What often happens is a copper producer with byproduct silver pre-sells the silver production to a streamer in return for a disproportionate share of the capital cost of putting the mine in production. The governments are much more inclined to steal than to trade. So what I think you'll see in the case of the copper business is de facto nationalization. Rather than stealing the mine outright, you will see them increase the requirement for offsite capital contributions, like building schools, roads, and water systems, increasing taxation, increasing duties, and increasing royalties. Stealing the output very much like the U.S. government stole the oil and gas industry's output with excess profits taxes. I don't think that the ratio, which is to say 16 to 1, matters because it doesn't take into account utility. Prices move really as a function of utility. Silver has two utilities. One, which is highly speculative as a medium of exchange and a store of value, which is to say its investment characteristics. The other is its industrial utility, its use as a germicide, and its use as a reflectant in solar applications. So while I understand the first part of the question, I think the attention that silver adherents pay to the 16 to 1 relationship between the relative abundance of gold and silver in the Earth's crust is probably less important than the social roles that they've both played in terms of investment demand or the industrial roles that they both enjoy.
Rick Rule stated that he didn't think the 16:1 ratio mattered much because it failed to consider utility. According to him, prices move based on utility. Silver has two primary utilities. One, which is highly speculative, as a medium of exchange and a store of value, essentially its investment characteristics. The other is its industrial utility, its use as a germicide and a reflectant in solar applications. While he understood the interest in the 16:1 ratio, he believed the focus on the relative abundance of gold and silver in the Earth's crust was less significant than the roles they play in investment demand and industrial applications. Rule brought up an intriguing point about reversion to the mean, noting that the market share of all precious metals-related investments, including physical metals, equities, and public debt, was less than 0.5% of the total savings and investment assets in the United States. He emphasized that this was crucial, first because the number was so small, and secondly because the 4-decade mean market share of these assets was 2%. If reversion to the mean occurred, which he believed it would mean a 4-fold increase in demand for this asset class in the largest savings and investment market in the world. Rule found this to be a broad and competitive universe where reversion to the mean was an essential statistical tool. However, he cautioned that using this concept in more volatile or constrained markets seemed problematic.